We've talked about a number of changes which are pushing through the market. We've talked about AI, we've talked about technology, we've talked about investors coming into the market, but an important theme is regulation as well. And to some extent, it's an interesting sector because the regulator has been, I think, to a large extent, up with the pace, even pushing the pace in terms of executing its own policy to liberate the market and encourage innovation. So what Peter and I want to talk about is just where we've got to on the FCA's agenda, quick refresher on what's coming under MiFID II, and then looking at two, I think, really kind of on-point recent papers on guidance on how to do it from our regulators. Peter.
I'm Peter Wilson from the Financial Services team here. So I'm just going to talk about the financial advice market review, where we are now. I expect the majority of you are familiar with this paper that came out last year in March 2016. Effectively, part of it is looking at closing the advice gap and the role that technology can play in doing that. 28 recommendations, and the FCA has been in the process of implementing those over the last 12 months or so. So we've had a guidance consultation. We've had a baseline report on where the FCA is up to, and more recently, this summer, we had a consultation paper where the FCA has talked about updating its perimeter guidance, and part of that is looking at changing the definition of financial advice for regulated firms who are providing investment advice and moving to the personal recommendation as set out in MiFID. We've also had the ESMA consultation paper on suitability requirements, and that's updating ESMA's guidelines on suitability for MiFID II, and we're going to talk about that in a bit more detail in a moment. Last week, the FCA published its finalised guidance following the guidance consultation earlier this year, particularly focusing in on streamlined advice, fact finds and consolidating existing guidance in the marketplace. We're going to have guidance later this year which picks up on work that's come out of the advice unit. So again, we're going to talk about that in a bit more detail shortly. And then, as I mentioned, MiFID II comes into force in January next year. We're going to be changing the definition of advising on investments in the regulated activities order to the definition under MiFID II, the personal recommendation. The purpose of this is essentially to help firms diverge between providing regulated investment advice and providing guidance services. And that is ultimately to help clients, investors, get more information and be more informed and make better decisions. Just want to point out final suitability guidelines coming out next year. I'll talk about that in a bit more in a moment. The FCA also this year has published its suitability review for firms providing financial advice. It was pretty much a thumbs up, really, but I think something to be mindful of is that next year they'll be announcing how they're doing that again, and they will be looking at how firms have implemented MiFID II and the recommendations coming out from ESMA and the additional guidance, so something to have on the radar. And then long term, there will be a full review of the outcomes from the financial advice market review. So that's just an overview of where we are now. So MiFID II, suitability requirements, essentially not a huge amount is changing in terms of the tests, effectively understanding the experience and knowledge of your investments, what their investment experience is. But there are subtle changes, and that they're going to be set out in a new rule book that's going to be put into the conduct of business rules. I've highlighted some of the key changes that are coming through, but essentially there is an explicit reference in there to the fact that the use of electronic systems should not reduce the responsibility of firms, and I think that the panel highlighted that quite rightly earlier. And as I say, there are other subtle changes, but I'm not going to go into the detail of those, and these slides will be available after the session. So moving on to this ESMA consultation that came out in the summer, among other aspects, the focus of that was on recent technological developments in the advisory market and the use of automated and semi-automated systems for the provision of investment advice and portfolio management. We're going to talk about that in a bit more detail in a moment, but essentially there are 12 new guidelines which are set out over here, and the timeline, at the moment the consultation is still open. It's going to close shortly, and one thing to note is that it's likely that this final guidance actually probably won't be in force until after MiFID II has been implemented in 3rd of January. So again, it's worth familiarising yourselves with the content of this paper. So particularly focusing in on robo-advice, and again, that term's been used a number of times today, and I appreciate there's some dislike of it in the market. Interestingly, in the ESMA guidance, they have actually defined the term robo-advice and said that it means the provision of investment advice or portfolio management services in whole or part through an automated or semi-automated system. So I think there is some appreciation of that term. It may well be used going forward, and it is used quite a lot in the paper. The ESMA paper picks up on 3 points, and I think what's important to note is, to some extent, the UK market is ahead of the curve in the wealth tech space and the robo-advice market. So some of these things aren't particularly new for the UK market, but thinking ahead, and if you're looking at Europe, ultimately the other regulators will be imposing similar requirements to those that the FCA has put in force. It's also worth bearing in mind that obviously with Brexit, we don't exactly know how the interaction is going to work between the two regulators long term. So it is important to keep sight of what ESMA is doing. I think just to highlight what these 3 points are, and I've actually set them out on this slide here. The first area they're focusing on is the provision of information to clients. Essentially, robo-advice firms need to be clear and simple to explain the model that they're using. Where there is a degree of human interaction, how that works, and how clients can essentially access information about the service being provided. Area 2, again, is around the assessment of suitability. We've talked today, or the panellists have talked today, a lot about the fact there are human advisors, human people making the asset allocation decisions. But where that isn't there, how would you address inconsistencies in terms of how the suitability is being conducted? And if that isn't there, again, how do clients get help filling out their suitability questionnaires? And then the final point is on organisational arrangements. Again, need to have good systems and controls in place. Where firms are relying on algorithms, essentially ensuring there are people within the business that understand how that works, that they are actually competent to perform the role. Where there is limited human interaction with clients, how are the systems and controls in place to ensure that the clients get the best outcomes? And obviously there are risks when providing investment advice and portfolio management through an online channel, and how are those being managed? There's a lot more detail in the paper. I'm now going to hand over to Jonathan, who's going to fill you in on more of the detail. Yeah.
Well, the regulators don't define it. I mean, they're really looking to you to define risk. And maybe I'll touch on that slightly around the concept of a target market in a moment.
One principle of any sensible document is that's the definition. Risk is not defined.
Well, yeah, and I think we'll come on to that somewhat in a moment, and I'll try and keep up with the pace that Peter's set. So, just as I read the ESMA paper, Peter's just mentioned they raised 3 points specific to the robo-advice market, but they don't otherwise make many concessions. On their guidance on suitability, it would appear they're expecting even automated or robo-advisors to provide a full advisory service. And running through their paper, there's an expectation that the automated providers will address issues like cognitive or behavioural bias within customers. You will be asking questions: is there a divestment? Is there a product switch involved? And how does your online platform cater for that? Asking the customer questions about their back history and existing assets. Asking yourself, and making available to customers full advice on everything that they've got in their portfolio. The need to address issues like marital status, family needs, and all of these are, you might say, speed bumps in an automated process. As soon as the spectrum of a marital status picks up, the guidance is you should be thinking, does this person have the authority to speak for their partner? Can I provide this service to them? With family needs, I need to slow down, ask more questions, all of which are alien to an automated process. And the list goes on: age, employment situation, liquidity needs, etc. There's a requirement to address customer inconsistencies and provide help. Not all platforms are resourced to do that to the same level. Vulnerability, again, the requirement is to slow down, ask more questions around not just older customers, but also new ones. And I guess the whole point is that the automated market is trying to bring in new customers. So a large proportion might be new customers. So again, there's a speed bump there. There's also an interesting piece on insistent clients. What do you do with the client that keeps on coming back to your platform and, if you like, sort of manipulating how they engage with it? Should you spot that and deal with them? So that's at European level, and there isn't much of an answer to how an automated platform deals with these things. Thankfully, in the UK, and this has just come out this month, the FCA is ahead of the curve, and they've issued a paper called Streamlined Advice. They haven't defined that, but what they say is, and they say this does fit into the European regime, so in their view this is compliant with all that ESMA have just said. You've got to focus on your product governance, and I guess that's where risk comes into it. And I didn't answer your question. The regulator really expects the firm itself to, in identifying its target market, to think carefully, do research, assess data, beta test. What does risk mean in the context of that market, their objectives, their idiosyncratic sort of tendencies? And we've had everyone on the panel today has spoken earlier about the fact their predominant clients are in different age groups, different spaces. So I guess risk is different for each of those. In a sense, the firm's got to come up with its own definition of risk and what that means for its target market. Crucially, the FCA said that you've got to apply a filtering process. It could be a decision tree, some kind of process to filter out everybody who is not in your target market. They give some examples. I mean, they're just examples, but there's always, you've got to read the runes as the kind of things they think you should be taking account of. Does a client want a wider portfolio of financial needs covered? If your streamlined model doesn't address that, they should be exited, shouldn't deal with them. Are their needs too complex? Is their capacity for loss something that your platform covers? Obviously, if someone says, I've got zero capacity for loss, and that reveals itself in the Q&A, they should be exited. Are their debts too high? Do they have emergency savings? Should they be better off using their money to repay their debts? Do they have enough emergency savings? Should the message be, no, you're exited, we're not continuing with you, you need to go and build up your emergency savings fund, then you can come back to us? Is their time horizon too short for your streamlined model? Do they want existing investments covered? So the FCA give pretty clear guidance that all of these things, you should need to think very carefully about whether you should be exiting customers. There's then a sort of on the right-hand side, a process of ongoing monitoring of that status with a particular client, thinking very carefully about, is the interface you use with customers appropriate to deliver this streamlined advice? And we talked a lot about this earlier on some of the prior panels. Really interesting to hear Sean at Nutmeg say they use a lot of sort of behavioural web and analytics to see exactly what customers are doing on their platform. There's an expectation from the FCA that you will track what customers are opening, reading. Are they looking at your educational materials? Are they going back through questions? To validate and vet that actually they're having a good process, that their dwell time on your educational FAQ is long enough to mean they've actually got educated. If not, if the stats don't bear it out, you need to rethink how you're communicating it and try something else. So a real emphasis on using data and analytics to prove to yourselves that customers are engaging with your platform in the right way. Some other sort of commentary there in the FCA paper on suitability still applies. Streamlined advice doesn't get you out of that ultimate objective to give the right advice. There's some really interesting, just the penultimate bullet on what do you do when customers have existing investments? How do you discharge an obligation, either to take it on, advise on them, look at the switching, look at the costs, or how do you distinguish yourself from that and say, our streamlined advice just doesn't do that, and communicate really clearly to customers about that and the process you should go to make sure that's absolutely transparent if that's what you're going to do. So what might that look like? You probably can't see all of this, but I mean, the chief thing to do is start off with your target market. What does it mean to you? Of course, there are product-specific risks. You've got to think about, in terms of the asset classes you're looking at, what's their inherent liquidity risk, credit risk, counterparty risk, time horizon. Are they inherently too complex for your target market? So filter out those products which are on sort of, just too, in terms of risk, again, you've got to define it, what's too risky against any of these factors or other factors for your target market, and what's in scope. And of course, costs come into that, tax wrapper comes into that. Are they sort of capital growth? Are they income generative? And does that, create a complete sort of decision tree as to what type of people you're going to accommodate on your platform if your product's not income generative, but you purport to deal with an income sort of needy client. You've then got customer-specific risks, which you again need to think about in each and every case. Are they in my target market or not? Or am I putting them outside? Am I going to accommodate an analysis whether someone is married, has a family? Do I embrace that? What about if they're selling to invest, switching? Do they want whole advice? Some things I've mentioned about vulnerabilities, level of debt. For your streamlined advice platform, you've got to work out on each of those decision points, are they in or out scope? And I think what the FCA are going to be looking for going forward, I guess it's this decision there. If you're going to hold yourselves out as doing a streamlined advice product, and almost all automated platforms will do because you want ease of process and scale, I think you've got to show to the regulator that if it's a no, if the client doesn't fit in, then they should be exited. And I think going forward, the regulator will be asking you for stats. They come and do a visit. How many clients do you say no to? Can we see the MI, the management information on those statistics? And of course, if you say, well, we never exit any, we offer a streamlined advice service, but we never exit anybody, there's an immediate disconnect and you're vulnerable to challenge. Well, the two things just don't go together. It's not credible that everyone that comes to your platform is going to fall into your streamlined model. So I think it's important that firms think clearly about that and demonstrate how it's going to work for them. Obviously, then go through the suitability assessment, and it's only going to be sensible that in that assessment, your questions, the approach you take is measuring all the things you've thought about or the inputs into your target market definition. Of course, it makes sense. You've then got to make sure that your questions, the process you go through, picks up on all those issues and interrogates it. And of course, you get your suitability report at the end, which again should mirror and be transparent to the customer why they've got to the a recommended endpoint they've got to. What is it? I mean, pick up on, in written terms, it's because you've got a high level of debt that we're taking this approach. So it's really transparent. With all of this in the grey box, I think there are controls that the FCA have an expectation that firms will apply. Number one, it comes through really strongly in all of their papers, is transparency as to what the online service actually offers. I think what they're getting at is, and I've done it myself, got onto a couple of websites, had a play. I'm very quickly into the 10 or 15 questions that will determine my fate as to what risk allocation I get put into. And the FCA is saying, slow down. Before people start that Q&A process, you've got to stop and explain to them how this service works. I think so the customers really understand the significance of their answers. We heard earlier about what do you do with customers who tell a porky about their age, their income. We all know it happens. So I think there's a real emphasis on slowing down and just making sure the customer's really applying their mind to it and understands what happens through the process. I think a growing awareness of applying behavioural analytics to what your customer base is doing. I don't think the FCA is insisting on it, but they are commenting that that's best practice. They like what they see with firms doing that. But obviously, you've got to then use it in the right way. Then lots of all the other things come into the controls, clear, cohesive questions, look at customer behaviour, and then it's market testing a virtuous circle. You go all the way back and keep testing this. Is this working out correctly? FCA citing a nice example of one platform observing complaints came through predominantly through one distribution channel and worked out that the firm looked at that, the promotions in that channel were not as good as they could be, so they blocked it off or changed it. So being conscious about where the problems are coming from. And I think this is what the FCA are looking at. That's my reading of it. So I think lots of firms need to think about, are we streamlined advice? If so, how do we demonstrate that we've got our target market right? And I think a corollary is, how do we demonstrate that we're exiting the wrong sort of people? And how do we manage that? Do we say, we'll never speak to you again, or there's a 2-day block or a couple of weeks, or you can come back again? How do you manage that, rather than just let customers come back through, answer the questions again, so the gate opens and they get through? How do you manage that? And I think the FCA don't say, they're leaving it to firms to work out. Just very briefly to close, in a separate paper, some interesting observations from the FCA's advice unit on good and bad practice. I'm not going to comment on that, but it's worth a read. It's a really short paper, just lessons they have learned. And also a final flag, and it was in Peter's sort of chronology. We're looking forward to the FCA doing this is a competition-driven market study, so they're wearing their competition hat here. I think they did an asset manager industry study last year, and they sort of observed some data around charges, upfront charges, sort of long-term charging impact, profitability. So they're going back in to look at this. Platforms generally, so non-advised platforms, the big players out there, advisory platforms that we've been talking about today, management platforms are in scope, as are distributors, tech providers. So it's the whole system, and they're going to look at value for money. Is it really scalable? I mean, challenging the market to demonstrate that this can be profitable long term. So they'll look at it as if it isn't, there are going to be some crashes and different platforms will fail. So they want to validate that. So, I mean, some of you may be involved in that, but there'll be a lot of learning coming out of that, I'm sure. So we can look forward to that. I think we're going to close there for any questions, which I welcome, but if not, lunch. Yes.
What do you think is the benefit to the consumer of the shift to streamlined?
Well, I think the regulator, its entry point is you as the industry need to act in the consumer's best interest. That's their kind of bolt-on number one rule. So it's, in theory, it is in their interests, because if in fact they would be better off paying down a debt, getting that emergency fund, consulting with their partner what to do with their money, whatever those things are, that really the FCA is saying you should be honest about this. If they'd be better off going and taking care of that first, then you should enable that. And we can't trust the consumer to make those decisions. We've talked about it today, but it's been talked about for 20 years. Education does not penetrate far. If you're trying to educate the consumer market, the FCA's done it around, whether it's around mortgages or insurance, it doesn't penetrate far. And in a way, generations refresh very quickly. So you've got to, education, any initiative needs to be perpetual. So you can't trust the consumer to make their own decisions. So I think the emphasis is on you, the industry, to come back to that word, I think, exit. What are you actually going to do? And there are models out there that will, some of the questions will reveal that someone might not be the best for the platform, but they will still go in anyway. Maybe there's a phone call first, or they go into the lowest category. And I think there's pressure being put on that. But it's also permissive. If you get that right, then the FCA is saying, yeah, we are validating the streamlined advisory model, go for it. And in a way, it's leading the charge, say, compared to Europe. So it's positive as well. I think, so it is in the customer's best interests.
Is there under MiFID II full obligation of transparency for regards pricing of services?
There is, yes. And the FCA have said they think the guidance I've talked about is, in their view, consistent with MiFID II. So they've done that validation. But yes, there should be full transparency as to basis of charging and charges.
And how do you think it's going to be enforced here we're talking about UK, but MiFID is a European regulation, right?
Yeah.
So in some countries, transparency of pricing is not as it is in the UK, as you probably know. Do you think that there will be an enforcement from the ECB or anything like that?
I don't know. But I take the point that regulators are not as strong as the FCA in all jurisdictions. They're under-resourced, maybe don't have the focus. So I'm not saying, I think the ESMA paper is a good thing because it socialises and sort of captures the concept of robo-advice, as they call it, across Europe. So it allows a UK business, I think, to kind of look for that scale. It's accepted. Whether they're going to enforce it in the same way, I agree, it's an open question. I mean, the FCA, I think, will. I mean, this market study I mentioned, I mean, they will be looking into, are people being transparent on charges? Are they making too much profit? Are they using their market power? Is a larger platform really leveraging its status to get better discounts from funds on fees? Is that really happening? So I think they will put pressure in the UK market.
If it is coming from the UK, then most probably some of the countries will take it as happened with MiFID I. MiFID I was implemented in some countries like Italy, for example, on the back of the regulation in the UK. So to say that it's going to be enforced somehow in the UK, then probably will spread over.
I think so. You can see ESMA is following the FCA's footsteps in terms of adopting the whole concept of kind of automated advice.
But just flag as well that review that I mentioned with regards to the UK advisory market and how suitability tests have been performed. One of the points that the FCA did pick out as a potential downside was the transparency around costs. So I think it is going to be something that the FCA will continue to look at, and certainly with the review they're doing on platforms as well going forward.
Great, thank you. Sorry, question about.
Look at this simplified advice model. What about the grey area of guidance that was mentioned at the time?
Sorry, you could just repeat that. There's a fan there. I couldn't quite hear you.
The concept of guidance.
Yeah.
And how that fits within the simplified advice model.
Yeah, and it links back to something that Peter said. There's been confusion in the market for a long time about what is investment advice, and the European MiFID standard is clearly where you are obviously taking into account someone's personal circumstances and giving them advice on what they should do. In the UK, there's been confusion that even more generic guidance to someone without having asked them any questions about themselves, so they are an unknown factor, but nonetheless, if you purport to give guidance in a bit of investment research, which goes out to the market generally on, if there's a degree of specifics to it as to what investment to go into, that could be investment advice and is regulated. So they've accepted the FCA, they've caught up and said, right, we're going to distinguish now. If you're giving advice to someone in particular, full rules apply. If you're just giving guidance material, training material, general investment recommendations on a broad level, then softer rules apply. It's just about being clear, fair, not misleading, being sort of treating them fairly. Much higher level rules apply. So in theory, it should help firms distinguish when there's an advisory service, full rules apply, and here's just educational materials, guidance, and we can be relaxed about how that's regulated.
Is there any firming up of the definitions of high net worth sophistication within all this?
Not really. They're going to stay as they were under the current sort of MiFID I rules. That's pretty much rolling over. I don't think there's any material change there. So again, in a way, you've got to almost be at the quality of a professional investor. So you're not even necessarily high net worth. The amount you've got to invest is one factor, but in terms of your frequency of trading, your activity levels, you've got to be almost akin to a professional. So that the European standard is pretty high. And that guidance will stay. I've always thought myself that there's a disconnect between what the regulations say is a professional investor, which is high. It's you must be doing 40 trades a year in this particular asset class. It's almost as if you are a professional investor. But our understanding of the market of what we think high net worth or sophisticated is lower, and there's a bit of exposure there. I don't think firms perhaps appreciate how high the test is, but yeah. Sorry?
Do you think you'll be able to charge for the guidance description?
It's a good question. I don't see why you can't. I don't think that is something that determines whether it's one thing or the other. You could just commercialise it as a product. I suppose it's whether you need to think how that's going to fit into a commercial model. I think as the regulator thinks of it, it's more you're helping educate people as they approach a paid for managed or advisory service, so it's free. But I don't see why you couldn't look to commercialise it as a standalone service.
I think there's another point to flag which we haven't quite mentioned is the change in the definition. It only applies to regulated firms. So if you're an unregulated, unauthorised business, if you're providing advice or indeed guidance that would stray into the existing definition of financial advice, so advising on the merits of a particular investment, then you'd still be subject to that old test. So, for example, a business couldn't just set up to provide guidance services necessarily because it would be potentially at risk of straying across the existing advice boundary. So just to be aware of that.